All right, so we are entering the seasonal June swoon, that latter half of June where things get really bearish from a seasonality standpoint, and boy, did it get bearish today. So we followed up with some weakness we saw earlier this week post FOMC, finishing at the lows of the week, finishing at the highs for volatility, finishing June expiration. So now, is this it, right? How bearish are things really? Is it just a smoke screen? Is it, nothing? Are we going to bounce right back up and buy the dip again next week? So I'm going to break all that down, as I always do, to see if this is the pullback, if this is the beginnings of a broader exhale and risk appetite, more so than the very focused exhales that we've been getting in very small areas of the market. So I'm going to break that down in the video today, and we're going to take a look at a stock that where we do a directional, kind of a speculative trade that we've already done one in our class trading rooms on marketscholars.com. And then we're going to renew the trade for our trade idea of the day. I'm going to talk about why and what it is and why we're renewing that and for our trade idea. So let's go ahead and get started. Today is Friday, June the 18th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see how we finished up the day today. We talked about this in our technical analysis class earlier today on MarketScholars.com. The momentum line was kind of key to how we finished, because if we finished off on the lows of the day and extended to new lows, because it was middle of the day when we did our class, if we extended to new lows by the end of the day and then finished on the lows, which is what ended up happening, very good chance that momentum line drops to extreme lows. Otherwise, it was a pretty bullish pattern. But if it fell to an extreme low, which is down here below the 5th percentile, then that's a signal that the intermediate lines run above in this bullish territory may be coming to an end. You can see, this one here got to an extreme low, signaled the end of this intermediate run. This got to extreme low right there. Signaled the end of the intermediate run. So getting to another extreme low, near-term line, not quite getting an oversold territory yet. We'll see if we follow through on this Monday or not. But the market sentiment line still up above, and both of them are falling, but both of them are still above 80. So we're still okay on the S&P 500 from that perspective. That's on the S&P. On the Dow Jones Industrial Average, we have a different story. We're actually in bearish territory now on the Dow Jones Industrial Average, more bearish than we've been, right? We had a brief little, we got to 39.7 there, but didn't last very long. We bounced right back up. That was in February when the NASDAQ had its near-term or intermediate pullback. And over here, we came close. We dropped below 50, but didn't quite get in the bearish territory. And then now, without getting up above 80 on the intermediate line, we are now dropping in the bearish territory and well into bearish territory. We are in dark pink shading in the red line. The Dow Jones Industrial Average is starting its own intermediate pullback. Now, whether it does it by itself like the NASDAQ has done, or whether it extends into all the other indexes too, which is what I'd expect, I think this is kind of signaling, and the near-term line is below 20. The near-term line has been in bearish territory for a long time, which is very, that's a typical pattern of bearish moves, and the near-term line stays in the pink area here for a while. So very bearish from that perspective. Let's take a look at the other major indexes. The NASDAQ 100, you can see still relatively bullish. Remember, it doesn't have the same. It's not nearly as bearish as some of the other indexes are, because it's already had two exhales, right? So it's got a little bit better margin of safety compared to the other indexes, which have not had any exhales yet. But it did get a Harami pattern, an inside day, very much an inside day, coming from yesterday. You can see the momentum line dropping. We still got a very strong bullish posture. So nothing's bearish, imminently bearish in the NASDAQ, which again goes to show that these large cap tech names may well end up being safe haven trades right now. They might not stay up very much. They might go through an exhale eventually, but they might hold up better than, say, the Dow Jones so far, and then the Russell 2000, which is below its moving average. Getting some oversold momentum line as well, not to an extreme, but oversold momentum line. You can see the intermediate lines falling pretty rapidly, and market sentiment lines in kind of neutral territory, which makes sense because we've been so sideways for multiple expiration cycles here. So very bearish pattern for the S&P, especially for the Dow. But let's take a look at the weekly chart now, since we are at the end of a week, and we'll see what its weekly market forecast looks like. And you can see here that is also hitting to an extreme low. Like, I mean, that's what the Dow kind of looks like, right? Very, very strong intermediate posture. The near-term line now is not in bullish territory anymore. It's dropped out of it. This is more, the blue line on the weekly chart is more in line with the intermediate line on the daily chart. And then extreme low on the momentum line. Again, we got an extreme low at the end of the intermediate run over here. We got one over here as well at the end of that intermediate pullback back in, what was it, 2019. You can see some of these others that got to extreme lows on these momentum lines down in this area. You can see another one over here. All of these kind of towards the end of bearish moves. This is one of the first ones I've seen that's actually at the beginning. At least, we haven't had a bearish move yet. So you would say, you would prognosticate that it would be the beginning of a bearish run. We talked about the Dow Jones and how bearish it is. Very same thing. Look at that near-term line. Not only is the near-term line out of the bullish territory, but it's in bearish territory now. And the momentum line, extreme lows, a long ways to go for that intermediate line to roll over. And then the Russell 2000, which has been so sideways, same thing, dropping to an extreme on the weekly chart, mind you. Intermediate line's got a long ways to go to the well up above 80, still above its moving at market sentiment line. It's been grinding. So you can kind of see that, all of these signs kind of point to the beginnings, stages of an intermediate exhale, not the end of one, which is what you would typically get when you got such an extreme low on the momentum line. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to do another video again on Monday. It's a quick way to let us know that you like our videos. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, you can do it right now even. While you're watching, just hit that thumbs up. It goes a long way for us. We really appreciate that for those who do. Also, join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, click over here on some of the things on the right, including our Market Outlook Live trade review. Click on that icon, or you can get to it right here. This is the video, about 10 to 15 minutes. Every day I do the Market Outlook. I do this quick trade review video. I go through all the trades I've been putting on during these Market Outlooks to talk about, how they're doing, whether we should stay in them, get out of them. That's a little different than what you normally get, like say on TV when people talk about, oh, look at this stock or look at that stock. We actually trade it, we manage it, we position size, we manage the risk, and then we close it. We talk about when and how to close it. So that's what these videos are for. So if that interests you, check it out over here. These are all example trades of things that we do in our trading rooms to a larger extent. You can see these are over here on the right. All of our paid subscribers get access, our premium and our plus subscribers get access to all of our trading rooms and the Market Outlook live videos. Of course, the Q&A sessions, as well as premium resources and access to our class forums are available for our premium subscribers who get access to all of that for a cheaper per month cost than what the month-to-month do. So lots of benefits to being one of our premium subscribers. In fact, I would say about 98 some odd % of our subscribers are premium subscribers as a result of that. Come down here, click on this heart, it opens up a new tab, click that like button there. Also come down here, click on this thumbs up icon, opens up another new tab, click on that like button again. The more you do that, it really helps us out because the more engagements these posts have through likes and comments and shares, the more people will actually see our content. See, this is a very small number of people who actually follow my page on Facebook. So it also benefits you because Twitter and Facebook will promote content within your timelines from the accounts that you engage with the most. So we try to make it easy for you to engage with us right here on this page while you're watching. Alright, so now let's take a look at some of these other charts. Let's take a look at the 3 green arrow chart, and look at that. We have 3 red arrows with a spike in volume. Big jump in volume, up to 118 million shares trading hands. We'll talk about that again more here in just a second. From a 2-line version standpoint, we are well below that. This was the first day we broke the 17-day. We broke the 17 and the 30-day moving average. at the same time. You can kind of see some other instances where that happens. You tend to be more bearish when we break the 17 and the 30-day all at the same time, when there's a pretty decent sized gap there. The MACD is relatively positive. If you take a look, the stochastic's dropping hard, way away from its moving average. The MACD dropping pretty hard, way away from its moving average too. Big histogram to the downside. If you take a look at the directional movement index, almost up to 30. That's almost to breakout territory. Well below 20 though. With the ADX low, it gives that suggests that there's room for this for a move to occur. In this case, a bearish move to occur. If you take a look at the RSI and the CCI, dropping almost below negative 200, almost below 40. If you look at the Dow Jones Industrial Average, we did drop below negative 200, well below negative 200. We are well below 40. So the Dow Jones, as I've said before, is in pullback mode. The NASDAQ now is still holding up a lot better, as you would expect. It's a safe haven now. The Russell is very close to having its own intermediate decline on this particular indicator. If you take a look at the Bollinger Bands, you can see that the Dow really broke below its point of control, below the lower Bollinger Band. It broke below the lower Bollinger Band at the same time that the bands themselves are breaking out of the Keltner channels, which are with a very, very low bandwidth. You can see how low that bandwidth is there. So, I mean, this is a breakout signal on the diamonds. Things are, needless to say, things are getting relatively bearish on this particular indicator. IWM had been bullish, obviously not anymore, as we're turning around pretty rapidly and flirting with we are in the lower quartile of the bandwidth on IWM. Of course, SPY, same thing. We are well down. In fact, we almost broke below. We are way into lower quartile on SPY, and of course QQQ. We're still in the upper quartile. It's like the Qs are like, what's going on here? Why is everybody going so nutsoid? If you take a look at the trend strength indicator, the S&P is right there at the top of the cloud. The diamonds are in the cloud with a new bearish trend developing, a weak bearish trend, but a bearish trend nonetheless. So we're below -1, we're above 50, so we have a weak bearish trend developing there. If you look at IWM, it's not bearish anymore. Remember, it was flirting with bullish move. It's not there anymore. The Qs, we're still flirting with it. I mean, you're actually above 2 and you're above 65, so the Qs are actually still in kind of a quasi-intermediate trend. We're still above the green line there. So again, just goes to show the discrepancy and the difference between what's going on in some of these major indexes here. All right, now let's take a look at the intraday chart here, and you can see obviously there's a gap here from the dividend payment on SPY that really put some pressure on things. But regardless, even with things shifting down here as it's adjusted for the dividend, still a gap, a runaway, a very, very characteristic of a runaway gap. You gap down to the downside below a little bit of support here in the case of the point of control. We took off in the high of the day was right at the open. The low of the day was at the end of the day. If you take a look at the gap from this perspective, a significant gap to the downside. We closed almost 2%, about 1 1/3% when it accounts for the gap there to the downside. If you take a look at IWM, we did get a significant gap to the downside, and we closed more than 2%. And if you look at diamonds, again, significant gap to the downside and a significant close to the downside, 1.5% by the time you account for its dividends. So, in other words, like very, very characteristics of runaway gaps to the downside today on all these major indexes. When you look at today's volume and trading range, 118 million. The trading range when you account for the gap, so it was 3 points there, but then you account for about a few points of gap, so about 6 points total in range. That gives you, when you look at that in perspective, 118 million is a little bit off the chart up there. 6 to 7 points of range is a little bit here. I mean, those are bearish levels, but they're not extreme bearish levels that we would bounce right up because it's so extreme. That's the concern. If we continue in the 6 to 7 point range, we continue in that 100+ volume range, then and especially if the average starts to ramp up a little bit, then that's not necessarily, that's not going to be too extremely bearish. like some of these other really extreme bearish moves that were so extreme in the volume that this got bought up because they were so much, so quickly in such big moves. Whereas you look at like QQQ, which remember did have its intermediate pullback, it had some extremes as well. The extremes ended up being the ending of the decline. The ending of the decline here is where the biggest extremes occurred. You can see we're not quite getting that yet on IWM. Of course, diamonds getting the most. I mean, that's a big chunk of volume there today for the diamonds relative to what we've seen in the past. When you take a look at the volatility moves today, you know, again, we're not quite to bearish territory yet. If you take a look, here's VIX 3M. For some reason, it's not showing down here at the bottom, but there's VIX 3M down there, 22.25. Now we have the VIX 3M ratio. It's on that. It is showing on a daily chart. So here's the VIX up to 20. We are up to 90%, but that's it. I mean, that's not a. As you saw, VIX 3M is at 22.9. Like, again, we're not in pullback mode, at least on the S&P, until you're above 100%, 105%. So, but still a pretty significant move in volatility, to say the least. When you look at the volatility on an options expiration cycle, give it a moment here to pop up. Here we go. So you can see we finished the cycle, but you notice we finished at a very small range, the top of the range, 6 points, so pretty close, but in a very, you know, a bigger range than what we had this a few days ago, but still very small compared to what we've seen in previous expiration cycles. And so you notice too, not only did we have a small range, but we didn't have a long upper shadow, which is typical of expiration cycles too. These you typically get at the beginning of the cycle a bullish run on volatility to the upside, and then we close at the bottom end by the time we get to expiration. Lots of filled in candles here. Even on the open candles, we have long tails here to the upside on volatility. Didn't get one this month, which means very good chance when you include that with the smaller range that we get a long shadow on the next expiration cycle, which means typically that you get your volatility jump early in the expiration cycle rather than at the end. So that's starting Monday. So we'll see if that translates into a jump in volatility early on. And if it's jumped high enough to get us to 105%, then we know we are in exhale mode at that point. So to summarize the technical outlook, we are seeing signs like that was a pretty bearish close to the week. And the Dow Jones Industrial Average is in its pullback mode. So, you know, that's rare. Like, we haven't seen that one. That's actually been the calmest one out of all the indexes for all these different months that we've been on this intermediate rally. It's been the NASDAQ that's been a lot more volatile. It has its own two exhales. The Russell has been a little bit volatile because it's been flirting with exhales while staying in a very sideways range for months. And the Dow has just been charting forward, progressively moving forward. But not the case this week. Very, very bearish week in the Dow suggests that we might finally be getting that broader exhale that will be more than just what we've seen in the NASDAQ. And the NASDAQ actually might end up being a safe haven area by the time all is said and done, as you'll see here on some other charts. So what do you think? So that's my expectation. My expectation is we are now moving in towards that period where we breathe out. Right? We're not dying, right? We're not in our sick beds. We're just, as of right now, just exhaling. Now, it might appear that we're sick only because we were so bullish, right? That's, you know, the fact that we've been so bullish for so long will make a normal exhale appear like we're sick. Because it will be deeper and more painful for some people than they expect. But the reality is the only reason why it's deeper and more painful is because of how big and how long the inhale, the impulse move was that started there in that Halloween low point for the S&P, and that potentially may be culminating right now. So do you agree with that? Do you disagree? If let me know. Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggests why you're a lot more bullish or a lot more bearish than I am? And share those with us in the comment section below. All right, now let's take a look at the price action here. So bear with me one second while I get this chart loaded up here. We'll take a look at the asset class comparison and then how things have changed. We've talked about this inflation trade that's been going on for quite a while here lately, with real estate and gold and commodities doing so well. Well, if you look at in bonds underperforming, if you take a look at what's happening here now, you can see today this was a risk-off move. Bonds, long-term bonds are up a lot. The dollar is up a lot, relatively speaking. The Qs, which is our safe haven right now, are up a little bit. High yield is there underperforming long-term bonds. If you take a look at equities, gold is down because of the strength in the dollar. Small cap stocks are down. Commodities are down, though they're up a little bit today. Real estate's giving back some gains. International stocks are down, with emerging market stocks holding up a little bit better. I mean, that's a complete reversal. We've been talking about the signs that things are, some of the other signs of risk aversion and some other asset classes throughout the week here that are playing out. And then, of course, for the Euro-US dollar, that's a big-time drop. And the Euro-US dollar way far away from its moving average. It'll be kind of hard to extend away too far away from that. But, I mean, we are in intermediate pullback mode on the Euro-US dollar. We are way down there, way away from the 8-day moving average. The MACD is extremely low. The histogram is deep. We'll see, how much further this goes down here. If you take a look, at the 17-day PPO here to see just how bearish we are here. Let me get rid of the MACD and let's do fit the studies, and we'll use log scale. Okay, so there we go. And then let's go out to like a 5-year chart on this PPO. So you can see we're not as bearish as we've had other instances where we've been more bearish, but not very much more bearish, right? You can see that was actually the COVID low point there. This was in 2018, the first quarter of 2018, when the euro bottomed out. I mean, needless to say, this is one of the more bearish times that we've seen in a while on the euro-US dollar, or bullish times on the dollar. How much further can it go down? We've talked about this area of support right around 117.50. That's going to be an area of support again. So it's only another 100 pips away. There might be bouts where where the euro bounces, but we might not get a new bullish trend again for a while until this risk aversion trade is over with, and that would coincide with bonds ending its run to the upside. You can see bonds have really broken out. Long-term bonds have broken out and are starting to work their way into this volume gap area. I think they're going to end up working their way up towards this 38%, probably closer up to this 23% line, that 157.88 area. By the time all is said and done here, let me kind of give you an idea of where that number is coming from. That is this retracement that we broke down. Obviously, getting back above that would be a renewed bullish long-term move on bonds. I don't think we're going to get there, but I do think we'll get to some resistance in that area and kind of stop. And that's when the risk aversion trade will be over. Otherwise, I mean, as of right now, we are breaking out. I mean, bonds have broken out. The dollar has broken out. This is risk-off mode, and commodities have broken down. They've been so bullish for so long here. There you go. They've been so bullish for so long. You can see it's very top-heavy. The point of control is right where we're at. Breaking down here will get us a move down to about 1670. Doesn't sound like a lot. That's a 20% drop. Again, it would be reflective of not necessarily the inflation trade's over with, just that we've gone kind of parabolic in this inflation trade here with a very strong move to the upside, obviously on the daily chart there. If you look at the weekly chart for the DMI, we're kind of peaking right now from a parabolic move. So I think this parabolic move has ended, and we'll start to consolidate some of this run and then start a new bullish run that will look more like this, more of a gradual move higher, not so parabolic, but more gradual. That will take longer, and it will coincide with bullishness and risk appetite, but not until we have a consolidation first, and then it will be a more gradual move higher in risk appetite, and not these big jumps and hard spikes that we've been seeing in different rotating asset classes over the past so many months. All right, now let's take a look at how the sectors are performing, and of course that's an issue, right? And to show you that these sectors We've talked about this idea of these large cap sectors being a safe haven. Well, let's take a look at just this week alone. Here we go, and then go to the 10-minute chart. XLK actually finished the week with a gain. In fact, this is one of the very few weeks that XLK, I tweeted this, I retweeted this out. There's a tweet that I put out there about the rare instances where we have a week where the XLK finishes positive, where XLF finishes down by more than 5%. There's been some interesting weeks in there. 2000, 2007, 2008. It's not necessarily the best sign to see that discrepancy. You also see that showing up here in this chart. Look at this big breakout on the QQQ versus IWM. Big breakout move to the upside. We talked about before, when this really gets going to the upside, I expect it will get back up above 2 by the time all is said and done. It was up to above 2 way back in the 2000s, late 90s and 2000, before it ultimately peaked. I think we're going to get there again. We're going to diverge. It's going to be a lower high point. We're not going to get that high on the PPO. We're not going to, actually the PPO needs to be, we're on a week, since we're on a weekly chart, I need to change this here. We're not going to get that high in the PPO again on between the 10 and 40-day moving averages. The MACD is probably not going to get that high. So we're going to diverge. We're going to get higher highs with lower highs here. And like I said, it's going to be more of a grind. But at first, it's going to rally with weakness in these small cap areas, these sectors that are more correlated with small cap stocks. And we're seeing that this week. I mean, energy and financials and materials and industrials all down. They've got months of gains to still recover. If you just go back to the beginning of when the NASDAQ peaked back in 2000, September 2nd, 2000, that's when the NASDAQ peaked. Energy also peaked down. Even with that big drop in energy, it still ended up with the biggest gains. That's how much of a gain it's had off of, this would be the September, or the October 28th low point, it looks like. The Halloween low point. If I were to go to that Halloween low point there, you know, there's the big gains, almost 100% in energy, big gains in financials, big gains in materials and energy. They're going to give some of those gains back. And some of these areas, safety trades, of course, but some of these large cap tech areas, they haven't gone up so much. They don't have as much to lose on the pullback. So you're seeing a very, it's not surprising at all to see this chart here flip-flop itself over the last, I don't know, let's see here, let's go see, when did we start to peak here. Let's go back a little bit further so we can see when the exact peak, well, we can come over here. Let's go to this chart, and let's go to a daily chart on a 6 month. There we go. And inspect. So it looks like we bottomed out there on, what day would that be? June 8th. So let's come back now over here to this chart, and let's take a look at June the 9th. So the next day after that low point going forward. So we'll come over here to like a 10-minute chart. So here's the return since they started to lag behind. Small caps, industrials, financials, excuse me, materials. That's when they started to lose. Technology held up. Since then, you notice technology is actually up. Healthcare is up. Utilities was up. Now it's negative, but holding up better. And you can see, look at what's really dragging. I mean, it's like industrials, energy, materials, financials are dropping like a rock, and they've got a long ways to drop because they have such significant outperforming gains, you know, that they have a bigger exhale. Again, only because the impulse move was bigger. Nothing significantly bearish about those particular sectors in terms of fundamentals or you know, that now things are just horrible. No, just that you can't breathe in forever without breathing out, and the deeper the inhale, the deeper the exhale will ultimately end up being. Let's take one quick glance here at the 12 grid for the sectors. This is interesting here. Dark pink shading and red lines across the board. staples, utilities, materials, industrials, financials, all dark pink shading and red lines. Energy has got the red line and close to dark green shade or dark pink shading. Discretionary is closer to dark pink shading, and we'll have a red line if we go down a little bit more. So I mean that's all bearish. It's not surprising to see that the S&P will start working its way to dark pink shading and a red line here pretty soon itself, as we get more and more of these areas following suit. And when stocks go up, different things might grab the baton. It's like a relay race. Different things will grab the baton and lead for a while. But when things go down, typically everything will go. When we actually have an exhale, not just like a little one on the Qs and kind of one on the Russell, but when everything has an exhale, then everything moves at the same direction. You'll see dark pink shading and red lines all across the board here. And we're starting to see that more and more. All right, so that brings us to our trade idea of the day. And one stock that we've been looking at kind of on a bearish stock before was Micron. And you can see Micron here. Let me bring it up on this chart over here. Give me 1 second to bring this chart up. Oh, this is it. So Micron's been dropping. It didn't quite. In fact, let's look at the Bollinger Bands. Let's do that one instead here. Let me bring up the Bollinger Bands from Micron. We tried to make a bearish trade on this before when it looked like it was trying to break the 38% retracement level there and get into this volume area. And then it bounced back up, didn't get back above the 23% line, made a new run at the 38, and then today at expiration broke back down. And that's the idea. I mean, that 38% line is right at some volume support. So breakdown's very bearish, and there's very little volume, so it can make a really significant move to the downside. Over here, the bandwidth is a lot higher than where it is now. So, you know, we're really kind of pushing out, you know, below the lower Bollinger Band, just barely, but below the lower Bollinger Band there. If you take a look at some other indicators, you can see breakout signals there as well, almost above 30, but well below 20 on the positive, almost above 30 on the negative. ADX is rising. You take a look at the RSI and the CCI indicators, and you are well below negative 100, breaking below 40 on the RSI. Look at the trend strength indicators here. We are, you know, we are working our way back up towards a bearish trend, well below the cloud. And the red line getting below the price there. You take a look at the 3 green arrow chart with the 2-line version here. You can see how we were converging, and now we're starting to diverge again with a big move away from the 30-day moving average. The MACD itself is dropping again. So relatively bearish patterns all across the board here. Here's what the long-term chart looks like, and you can see we were bearish, we got some bullish transitions, and we're back to bearish again, just like that. So I'm going to trade another bearish trade, a little bit more a speculative bearish trade again on Micron. There was the one that closed out here in June in our class. I'm going to repeat that trade, this time selling the 67.5, buying the 70. That gets us a move potentially down into the 67.5 area would be down here. To 1 standard deviation would be down to the 62% retracement at the bottom, but you notice there's not very much volume there, so there's going to be a support that is not supported by a whole lot of volume. So if we get to that level, it's going to be very easy for it to keep dropping if we are in a broader risk off mode. And we'll see a very small position on this trade. There we go, very small position on this trade, but the potential for about almost a 6-to-1 reward to risk ratio here if it ultimately plays out. So, sorry, this one here, 5-to-1 reward to risk ratio. That was the old one. This is the new one, 5-to-1 reward to risk ratio if it ultimately plays out, like some of the other bearish trades that we've done here, direction like Deere. We did a trade on Deere that also had a very similar, very small risk, 5-to-1 reward to risk ratio. And it did play out, and we got a really good reward because of it. So very similar type setup that we did in that trading room, in our trading room. This would be another example of that type of trade if it works out. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. You can open up any new thread, reply to anybody else's thread. with any questions or comments you have today about the video, about what we discussed in the video. Let's keep this conversation going here over the weekend in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, like us on Twitter and Facebook too, and comment on the video. Have a great rest of your weekend, everybody, and we'll see you all next time.